Now that you've had an introduction to a few of the basics of the sector, it's time to begin to look in more detail at other issues. Let's begin with everyone's favorite, the law. While charitable organizations existed in the United States long before anyone had even thought of inventing the income tax, it is the federal tax code that established the basis for the not-for-profit sector as we know it today. The tax code confers certain benefits to not-for-profit corporations. In return, the government insists that those corporations be overseen by individuals who will ensure that the corporation is serving the public good. This is the fundamental reason for the existence of boards of directors in the not-for-profit world. The language you see on this slide comes from the tax code. The primary reason I include it is simply that I don't get to say the word in your very often, and I think it's a lot of fun. I guess it also serves to highlight the fact that boards of directors are volunteers serving the public. To be excruciatingly thorough, there are two different types of boards in the not-for-profit world. One is boards of directors, one is boards of trustees. We are not going to get too exercised about this, and none of you should lose any sleep over it. The technical distinction is that trustees are in charge of organizations that have considerable assets, like colleges and universities or hospitals, and directors are the rest of us. In everyday discussions, the terms often get used interchangeably, and that's perfectly fine. The only time the distinction really matters is in the case of lawsuits. Then trustees are held to a higher legal standard of responsibility than are directors, hence the phrases gross negligence and negligence. However, we're just not going to worry about that now, and we'll probably not be worrying about it too much at all. Oh, well, there is the outside possibility that it might come up on a test sometime. These little boxes illustrate the traditional organizational structure of not-for-profit corporations. The top box represents the board of directors that generally has an executive committee that oversees the work of the board as a whole and is populated by a series of standing committees that help carry out the work of the organization. The lower box represents the staff, headed by a chief executive officer, often called the executive director, who oversees the rest of the paid staff of the organization. As we begin to look at tax issues related to not-for-profit corporations, we start with the things that get most people's attention. That is the benefits of being a not-for-profit corporation or a 501c3 corporation. First, revenue coming into the organization is not taxed. For many, on first hearing, this doesn't sound like a very exciting benefit. Yet, if you remember, the not-for-profit corporation is a corporation in the way that any for-profit corporation is. So without this aspect of the tax law, it would be paying taxes on the income that it generates. Next is the mother of all perks for not-for-profit corporations. The fact that when someone makes a donation, they are able to deduct the amount of that donation from their taxable income. It is important to remember that when an individual does take that deduction, the government is foregoing income and is therefore subsidizing the work of that not-for-profit based on the choice that the individual donor has made. This is an interesting fact that has many public policy implications that we will be addressing in this course and in the ones that follow after. Owning property can be a blessing or a curse, or sometimes both. For those 501c3s that are blessed and cursed with real estate, in general, they don't have to pay property tax on it. So long as a 501c3 is using its property for its exempt purposes, there is no tax obligation. However, if it is being used for non-exempt purposes or even not being used, there is a good chance that the organization will have a property tax liability. I hedge my bets by saying there is a good chance because in this, as in many things in this course, I shield myself behind the disclaimer that I am not a lawyer, an accountant, or an insurance agent. For particular expert advice, please see a particular expert. And now we get into the mixed blessings having to do with 501c3s and taxes. When a not-for-profit is in the regular business of selling things, in general, there's going to be a requirement to collect sales tax on those sales and transfer that money to the government. We will consider this in more detail later in the course. The flip side of this is that a corporation that is recognized as 501c3 by the federal government can apply to the State Department of Revenue for refunds on the sales tax it pays when it makes purchases. This is not an automatic benefit of attaining federal 501c3 status, but it is something that is a possibility. This is one of those aspects of the tax law that I have had the opportunity on more than one occasion to share with especially small or newer boards of not-for-profit corporations that was surprising and joyous news for them. Employees of 501c3s are treated for individual tax purposes exactly like employees of for-profit corporations. The one exception to this is the spiritual leaders of religious organizations, pastors, priests, ministers. They are treated as self-employed individuals. This has to do with the tradition of the separation of church and state and the notion that the power to tax is the power to destroy. With that one very small caveat, this particular issue is of vital importance to the legal status of not-for-profit corporations. It has been said that there is little better way to have U.S. Marshals show up on the doorstep of individual members of a board of trustees or board of directors than to have that corporation not file its tax returns and send in its tax payments in a timely fashion. Boards really need to pay attention to this one. And finally, we have unrelated business income, referred to as UBI, and tax on that, unrelated business income tax, UBIT. Increasingly, not-for-profit corporations are generating income through activities that are not directly related to their exempt purpose. This is okay. However, like most things in life, there are rules that go along with it. First, and most importantly, the 501c3 is responsible for reporting and paying income tax on this revenue exactly like a for-profit corporation is. Second, it's important that the amount of income that is not related, in other words, that is unrelated business income, does not make up a substantial portion of the organization's total revenue. There is no precise standard for substantial in this case, making it one of those wonderfully obscure elements of the tax code. We'll talk about some guidelines related to this later in the course. This brings us to the end of our very brief introduction to aspects of the law as they affect not-for-profit corporations. If you are like most people, now would probably be a wonderful time to go do something to clear your head, like run a mile, swim several laps, or take a cold shower.